Hello and welcome to Macrosutra. This is Akanksha Mishra. It has been a month into the new financial year, and so I think this is the time that we can get into some discussions about how certain budget projections are going to pan out this year. First up, the government's target to keep the fiscal deficit at 4.4% of the GDP for the financial year of 2026. How realistic is this target, and what are the factors that it depends on? To analyze that, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you for being with us, Radhika.
Thank you, Akanksha.
Now, before we begin, I'm just going to set some context. Fiscal deficit here, for our readers and viewers that don't know, it refers to the difference between the government spendings and earnings, and the lower it is, the better. The reason Budget 2026 had an ambitious fiscal deficit target is that we have high hopes of tax collections, revenues from RBI, and revenues from disinvestment. But in the last financial year also, our direct tax collections grew by almost 16%, which is why this estimation was not unfounded. But in the middle of a global tariff war, challenges are bound to ensue, things are bound to be different. So let's start off. There are some unique challenges this year to our tax collection, which include both corporate taxes and direct taxes, income taxes, that is. Can you tell us what these challenges are?
Yeah, so there are some unique challenges. First, let's look at the budget projections, that is for the current financial year, FY 2025-26. So here what we see from the budget documents is that the gross tax revenue is projected to grow at 10.1%. Income tax is projected to grow at 14.4% and corporate tax at 10.4%. So these are the year-on-year growth over the revised estimates of last year. We also know that in the budget, there was a lot of emphasis on tax rationalization. Income tax in particular saw cuts in rates and also raising of the exemption limit. So effectively till 12 lakh, there is a tax relief because of which there is going to be a revenue hit to the government equivalent of rupees 1 trillion, rupees 1 lakh crore. So that's the background. So we should also remember that budget was set at the time when we did not know about these tariff wall, the escalating tension that we are now seeing. We are talking about reciprocal tariffs, how they would impact growth, revenues, exports, and so on. So in the light of these global developments and challenges, we think that these revenue assumptions would need to be reassessed. They would need to be recalibrated. So even if we leave aside the global challenges, the tax assumptions or the tax projections for this year look optimistic. Particularly, the income tax growth rate is projected at 14.4%, even though there is a cut announced in the budget. So, even after that, we are assuming a 14.4% growth in income tax collection. Even for corporate tax, we are assuming 10.4% growth rate. But if we look at the profitability of companies, we are seeing that it has been moderating. So even not considering the impact of global headwind, we think that these assumptions, particularly the direct tax assumptions, are on the optimistic side. But now comes the influence of the tariff wars, the uncertainty, the lingering uncertainty. We know that right now the tariffs have been paused, but we do not know what will be the contours of the US-India trade deal, how the tariffs will pan out, what would be the impact on growth. But in general, there is a need to think that corporate tax collections would be hit because the companies' profit margins, those companies, particularly those who are in the export sectors, those who are producing goods that are export intensive, they would have to reconfigure their supply chains. That would require increase in costs, that would require increase in compliance. There would be some adjustments for some time at least that would have a hit on profit margins and consequently on corporate tax collections. So corporate tax collections are likely to be hit due to this uncertainty and the need to reconfigure supply chains, to look for alternate trading partners, to look for different markets, to look for different commodities, diversification of trade. So this adjustment would involve some hit to corporate tax collections in financial year 2026, and that could also have a rub-on impact on income tax going forward, because if corporate tax collections are going down, that means profitability is going down, wages could also be impacted, and if wages are impacted, then income taxes could also be impacted. So
Yeah.
there is in a nutshell, the tax collections assumptions were on the optimistic side. They were ambitious, and given this global headwind, there are some challenges that the government would face in achieving the direct tax collection targets.
Okay. Now, staying on taxes, data shows that corporate tax buoyancy in financial year 25 is below 1. First of all, what does that mean? If you could tell us viewers what that means. And secondly, what does it indicate about fiscal deficit?
Yeah, so tax buoyancy indicates whether tax collections are rising in tandem with the growth of the economy. So we are saying buoyancy means the growth rate of tax divided by growth rate of GDP.
Yeah.
So if the buoyancy is less than 1, that means that if your economy is growing at say 10%, nominal GDP growth is at 10%, the corporate tax growth is less than 10%. So that means even if corporate tax collections are strong in absolute numbers, they may not be growing in tandem with the size of the economy. So that is the buoyancy. It's a very important metric of fiscal policy, that we are not only looking at increasing taxes in absolute term, but we are also looking at buoyancy. So having set this context, if we look at financial year 2025, notably till now we don't have data on the entire financial year April to March for the previous financial year. It would be released on 31st May. But from the CBDT, that is from the Central Board of Direct Taxes, we do have data for direct taxes, that is for income tax and corporate tax. And when we look at that data for corporate taxes, we see that corporate tax growth has been net of refunds. Okay, so the net of refunds, corporate tax collection growth in the previous financial year ending March 2025 has been 8.3%. And the growth rate of GDP of the previous financial year was 9.9%, which is coming from the second advance estimates that were released in February. So 8.3% is the growth rate of corporate taxes, 9.9% is the growth rate of GDP. So that leads us to a corporate tax buoyancy of less than 1. Now, in the budget, the buoyancy is assumed to be more than 1, which is because corporate tax growth is budgeted at 10.4 and GDP growth is 10.1. So, buoyancy is assumed to be more than 1, which seems again a bit optimistic because of the challenges that we discussed right now. So, what is important is to analyze that the corporate tax buoyancy was already declining, was already on a declining path even in the previous financial year. So it could face some, because of the global headwind, the corporate tax buoyancy could decline further. In addition to the fact that corporate tax collections the growth could decline from 10.4 to say 9% or 9.5%, depending upon the hit to exports.
Right.
Depending upon how our exports pan out in this year, the corporate tax collections would the growth would be determined. If we are able to strike a favorable deal with the US, then our exports would be cushioned against the tariffs, and then corporate tax collections could be higher. But as of now, sitting today, there is a lot of uncertainty, and that also then reflects on the corporate tax buoyancy.
Okay. Now, one of the reasons why our tax collections might not be as projected is because our GDP might also not be
Right.
as projected in the budget. So, can you tell us a little more about the nominal GDP growth estimate in the budget and why that also sounds a bit optimistic?
Correct. So nominal GDP growth for this year has been assumed at 10.1%, and even last year it was assumed at more than 10%, and it came at 9.9% as per the second advance estimate. So now what is nominal GDP? It's a very important metric because all the fiscal metrics are benchmarked to GDP. We have tax to GDP ratio, we have fiscal deficit to GDP ratio. So all the numbers, all the fiscal policy indicators are linked to nominal GDP growth. So it's very important to have a very realistic picture of nominal GDP growth. Now, nominal GDP growth has two constituents, the real GDP growth and inflation. Now, when we look at real GDP growth, we spoke about in the previous episode that there are series of downward revisions to real GDP growth. The official number, or the RBI has also revised the real GDP growth by 20 basis points from 6.7 to 6.5, and various other agencies have revised it downwards to around 6%. Some are even suggesting less than 6%, around 5.8%, assuming that there is a hit to exports. Now, as far as our analysis goes, we have also done this, impact of tariffs on export, and we find that purely on the basis of this reciprocal tariffs, which may or may not hold true, that is there. There could be a hit to GDP growth of somewhere around 0.38%. So, if the real GDP growth goes down, that would have a bearing on nominal GDP growth as well as inflation. And we've talked about that inflation this year is going to be low. Global commodity prices are on a downward trajectory, which is a positive thing for us because we are hugely dependent on oil imports. So oil prices are expected to be on a downward trajectory. So both the constituents of nominal GDP growth, which is real GDP and inflation, are expected to be benign, are expected to be range bound. So nominal GDP is is expected to be lower than 10.1%, and if that is the case, that means that tax collections would be lower, because if the size of the economy growth is lower, then tax collections, economic activity would be hit, and there could be some challenges on that front also, coming from the fact that nominal GDP growth could slow down a bit.
Great, that makes sense. Now, moving on from tax to non-tax revenue, because tax wasn't the only source for us to reduce the fiscal deficit target. So, what about the non-tax revenue, specifically RBI dividends or the disinvestment revenues that the budget quoted? Are they going to be as projected, or what's going to be the change in the next year?
So, at the moment, we can only say that there are various sources of uncertainty, particularly for non-tax revenues, which is the RBI dividend to the government. Now, RBI dividend to government has been very healthy over the past 2 years. More than 2 lakh crore RBI has transferred to government, which has acted as a buffer in reducing the fiscal deficit. So, sometimes when tax collections do not come as per the targets, we have the non-tax revenue providing some sort of cushion. Within non-tax revenue, as I said, the key component is the RBI surplus transfer to the government, or in other words, RBI dividend to the government. And there are dividends also from state-owned bank, nationalized banks, and financial institution. But purely focusing on RBI dividend, which is the main part of this non-tax revenue, this flows from the income of the RBI and expenditure. That is, after netting out expenditure, whatever income is left, that is, and after making some provisions, that is the part which is transferred to the government. So, if the income is lower or if the expenditure is higher, then the profit, the surplus transfer to the government could suffer. Now, let us look at reasons why the income could be hit. It's not, we are not saying that they will be hit, but as sitting today, we can conjecture that there are some factors that could lead to some moderation in RBI's income. The main thing is that RBI derives income from domestic sources and foreign sources. Domestic income is the yield on government bonds, and foreign income is the yield on US Treasury yields. Now, since last year, we have seen that the US Fed has lowered its repo rate, its policy rate, not repo rate, its Fed funds rate thrice already. And in this calendar year, they paused, but they still indicate that the US Fed, they still indicate that they're going to lower interest rates once they are clear of the impact of tariffs on growth and inflation. So, in all probabilities, US T-bills are likely to see a slide that could have a bearing on RBI's income. And on the expenditure side, because there's so much of volatility on the gold prices front, on interest rates front, on currency front, so RBI would have to make more provisions.
Yeah.
If we look at the RBI's balance sheet, there are several provisions that the RBI makes. RBI makes provisions for credit risk, market risk, for monetary and financial stability risks, for currency and gold revaluation. So if there is a lot of volatility in gold prices and if there's a lot of uncertainty with regards to exchange rate, then more provisioning would have to be made. And if more provisioning is to be made, then the expenditure would be higher and the surplus transfer could be lower. So as of now, while this budget has projected overall non-tax revenue of 2.6 lakh crore, we do not know what is the bifurcation of this. We do not know what exactly of this is the RBI surplus transfer. But we do think that there could be some challenges in achieving this, given that there are headwinds on the income side as well as the expenditure side.
Yeah.
So that is the non-tax revenue. And the other thing you mentioned about disinvestment, that is already showing a slide in the previous financial year. Also, we see that the disinvestment revenue is going to be lowest in the last 11 years because of the market volatility. There is less appetite for the government stake. So disinvestment hasn't picked up, and therefore this time in the budget we saw government talking about disinvestment as well as asset monetization.
Yeah.
So the overall miscellaneous receipt within the non-debt capital receipts talks about disinvestment as well as asset monetization. And there the target for this financial year is kept at 47,000 crore. Now, because last year, which was seemingly normal as compared to this year, the government could not achieve. So going forward, again, as I said, because of the volatility in the stock market, it is uncertain whether the government would be able to achieve these targets.
Yeah.
So in a nutshell, on all the revenue fronts, there are these challenges. There are challenges because the tax collections were already pegged at optimistic levels even before taking into account the impact of the current external challenges. And if we do take into account of those, then at least on the corporate tax side, we see some challenges, and also on the non-tax revenue front.
Yeah. And to our viewers that would want to know more about the RBI dividends, I would suggest you go back and watch a couple of our episodes, because we did discuss the US Treasury rates in
Right.
those episodes. Now, finally, as you said, like there's challenges on the revenue fronts for sure, on different tax and non-tax fronts. But the fiscal deficit doesn't just depend on revenue; it also depends on expenditure of the government. So, what are the challenges on the expenditure front this time?
Right. So, on the expenditure front, again, before we delve into the impact of the external challenges, what we've been seeing is that the total expenditure to GDP of the government has been declining, and that is mainly due to revenue expenditure as a share of GDP has been declining. Revenue expenditure excluding interest payment has been declining. And even within that, if we look at the data for April to February, revenue expenditure growth has been just around 4.5%, and capex growth, which is the main pillar of the government's development strategy, in April to February, public capex grew just at 0.8%, so it was virtually flat. And again, for the next year, the budgeted growth is 10.1%. Now, given that private investment is already facing this brunt of uncertainty, it is unlikely that they will pick up, and that is quite well acknowledged in the government's own surveys. It's very important for our viewers to just to mention that the PIB and the MOSPI came up with a forward-looking survey on private sector capex intentions, where companies were asked what are their capex plans for the next financial year, what are they going to invest on, and so on. So all these interesting questions, though not all the companies answered, because they were quite conservative on answering these questions, but it does give us some indication about capex plans. It's a good initiative by the government to have some kind of survey in addition to the private survey that we already have, which is the Center for Monitoring Indian Economy survey. It suggests that in this year, the capex intentions are going to be 25% lower than in FY25, and that is understandable. So therefore, the government capex would have to step up. Ideally, government capex would have to step up to mitigate the impact of the slowdown in private capex. But when we look at the data, we don't see a very sharp jump in capex, at least till February. As I said, government capex is growing at 0.8%. So if we want that government capex picks up to cushion the blow to growth, then we need to see that various implementation bottlenecks that were faced in the last financial year are addressed, and it should have the growth should happen from the very first month of the current financial year. It should not be that it should be left to the last quarter and so on. So that would help in cushioning the impact. But as we saw last year, there could be a case where capex is actually shrunk so that we meet the fiscal deficit target of 4.4%, given that revenue collections could be lower. So there is this tightrope walk between maintaining a sustainable capex path as well as maintaining as well as sticking to the part of fiscal consolidation, which is 4.4% fiscal deficit, given the various challenges on the revenue front.
And since you mentioned that government capex expenditure was only 0.08%, if you could just tell us a little bit about what does the slowdown in government capital expenditure signal about the fiscal implementation plans in the government?
So it's very important to understand why government capex slowed last year. So we know that there were elections. So at least in the first quarter, there were election-related code of conduct. So capex slowed. But even after that, there were various challenges like uncertain weather conditions that prevented capex. And within certain departments, there are certain divisions and certain ministries where capex did not materialize as per the budgeted amount. So what it signifies is that if we need to set more realistic capex targets, and where it is possible for the ministries to actually implement, because there are capacity constraints. It's not possible to every year keep on spending 10 to 11 lakh crores every year at the same very pace. Because we are transferring some amount to the states also as part of the 50-year interest-free loan, and we saw that the state capex is also slower than anticipated in the previous financial year. So we need to the lesson that this year trajectory holds is that we need to set more realistic capex targets, keeping in view the various implementation bottlenecks and the execution bottlenecks, and set more realistic targets, and also see that we have a very periodic implementation plan, and not lump everything and leave it for the last 3-4 quarters.
Now, let's just take one audience question. So there's one by Ayushi. She asks, what steps can private companies take during such uncertain economic conditions? Is it a good time for IPOs, initial public offerings, for example, like Ather did last week?
So it depends from company to company, and it depends on sectors to sectors. The plans will depend on the conditions in which sector the company is. As I said, those sectors which are export dependent, and particularly those sectors where the tariff rates are very high, which are very, very vulnerable to tariffs, like electronics, like machinery, like metals, the companies would have to wait and watch. They cannot go ahead with capex implementation. First, they would have to take care of the existing capacity utilization before taking fresh investments. So it's very important to look at the RBI. As I said, RBI's capacity utilization survey is a good starting point to understand this. So that is one. And for those sectors which are domestically facing, so we have lots of sectors which are insulated from external shocks. Consumption related sectors, consumer durables, FMCG goods. Now there we are seeing that they are trying to recalibrate their strategies. What they are doing is that they feel that rural demand is still strong, urban demand is sluggish, so they are actually reducing the size of the packets. They are doing something so that the sales pick up. In the short run, that would have some impact on the cost because they want to increase the volume. So there is this some discussion going on to address the sluggishness in demand, and so that that does not have a bearing on their profitability. So they are recalibrating their strategy. So as I said, it depends on sector to sector and company to company, but in general, those companies which are insulated from external shocks, they are likely to do better, and they can go ahead with their capacity expansion plan. And also, when like talking about IPOs, it depends on for what purpose you are going ahead for the IPOs. Either you are doing for your working capital requirements or for fresh capacity expansion, for what purpose you are doing, it depends on that. And last, very important, it depends on market condition. Whether market conditions are favorable, is there adequate appetite for the bonds that are floated in the market to raise finance? That is very important. And the cost of borrowing. Are you able to issue bonds at cheap rates of interest? That is very important. So there are plethora of factors that will shape investment decisions and the decision to hit the market with an initial public offer.
Great. On that note, that's all we have for you today. Thank you for tuning into The Print.